Hello, I'm Robert, and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. Today we're going to talk about different types of dollar cost averaging take profit methods. That is, we can take the profit when the candle is fully above the line. We can take a profit on just the closing price, or we can take a profit on just the wick. We're going to discuss those particular functions with the charts. So really, for the first part of this, let's focus on just this part on the screen. The part where the candle dipped below the take profit line, and it should have taken the profit, but it didn't. Now I have the settings currently set to full candle. So full candle means just that. The take profit can only occur if the candle itself is completely above the take profit line, or in this case a short completely below. So we can see right here the candles in question. They clearly go below the take profit, and in fact one of them, the closing price itself, is below the take profit. So let's look at this carefully. We see right here that the wicks, both of them, are below the take profit. So why didn't it actually take the profit? Again, full candle means the high wick must also be below the profit line for a short position. So let's see what that looks like if I actually adjust the strategy to change how the take profit looks. For example, we see full candle. So let's change this to close only. And it's going to take a few minutes for the system to recalibrate. And when it does, you see that the candle now completely refocused on exactly how this strategy closed out. Since the closing price is now below the take profit boundary. So now what happens if we go with just the wick? Now the wick on a short trade is going to be right here. So we should get out one candle sooner. Let's see if it does. And we'll wait for it to update. And we see that it did just that. Okay, I found another example that is actually more visible and much clearer to see the difference as we look at these two candles. Now we see wick only. Clearly shows that this first red candle is the exit point. So let's look at close only. And now we see that it is the second red candle. But at the same time, if we go to full candle, it should also trigger appropriately. And it did. The first green candle shows specifically the close only. The full candle only. So let's zoom in this even more and really get these candles nice and big. And get a good look at exactly what we are looking at. So we can see on this green candle, the upper wick is below the green take profit line. So it is a full candle. We can see on this red candle that the close is also below. But because of spread, slippage, and other calculations, this candle does not qualify for a full candle, but it does qualify for the closing price. And then if you go on just wick only, we can see this candle. So this example has given us all three combinations. So let's back this up, bring up the settings, and actually go and see the impact of each one. So full candle, close only, and we see the red candle. And now let's show wick only. And again, we see the differences. Now, what does this really mean? Really, only one thing. Risk mitigation. That's it. If you go with the wick only, you have a higher probability of getting out of the trade sooner, but at the cost of some profit. The closing price is the standard market philosophy, whereas a full candle is trying to push the market as far as possible, at the risk of potentially having more trades occur, like what I demonstrated a little earlier. So let's actually see the larger picture and go back to the first example where we can see it got out. But now let's actually change it again and see how it changes the trade. So we have wick, we have close only, and let's see if this trade changes. And now let's go to full candle only. Now if we see, we just saw how it extended out the trade. It didn't take the trade. At least not at the point we thought it would. It did take it over here. So it kept us in the market a little longer. And that could have potentially been a loss. That really is the only difference between full candle, closing price, and wick. It is your risk level. How much risk can you afford to take on this trade? Let's go to the end of the chart where the statistics are and see how that shows up in the statistics. Okay, here are our statistics that show us our trade. Now let's go and actually see how changing the metric of when we take a trade affects. So for the full candle, we have 8 trades, a maximum of 3 buys per cycle, and an average of roughly 26 pips per profit. By moving to close only, we haven't really changed much. So close only versus full candle may or may not have a big difference. Now let's look at wick only. And we can see that wick only gave us one additional trade and slightly lowered our average. Now this will be indicative of every single instrument you trade. And based upon how you trade, it may or may not affect your trades. Some instruments may go all the way into a loss. For example, you might accumulate 5 positions in a case of this strategy for a full candle, but a wick may never go into a loss for that current market structure. So that is something to really look at and play with when you are looking at your risk assessments. Typically speaking, a full candle strategy will have more accumulation, whereas a wick-based strategy will have less accumulation. Always understand your risks. Let me know what you think about this technique. Which strategy do you feel comfortable with? Do you feel comfortable giving up a few pips or a partial percentage just to get out of the market and walk away with a clean profit? Or do you prefer to take that little bit more risk, even if it means turning into a loss, to get a slightly bigger gain? Share your thoughts and let me know what you think. Please give this video a like, hit that thumbs up. If you're not subscribed, please subscribe so you'll get more videos like this. Thank you for watching.